Here is a sentence that should make you deeply uncomfortable. This week, one of the biggest financial firms on Wall Street looked its investors in the eye, took their money, and then calmly told them they could only have 45 cents back for every dollar they put in. Not because the market crashed, not because there was a scandal, not because of some black swan event nobody saw coming, because the door is closed. And that's not the scary part. The scary part is that most people have never even heard of the market this is happening in. It doesn't have a ticker symbol. It doesn't show up in your brokerage account. It doesn't trend on Twitter. It lurks in the shadow banking system with a $3 trillion price tag, a target of $41 trillion, and right now, a default rate quietly climbing to levels we haven't seen since things got very ugly. I'm talking about private credit, and what's happening to it right now is the story of the year that nobody is covering. So let's fix that. To understand what private credit actually is, you need to go back to 2008, because the global financial crisis didn't just wipe out Lehman Brothers and the retirement accounts of millions of Americans, it also fundamentally rewired how banks were allowed to operate. After the dust settled, regulators came in with something called Basel III, a global framework designed to make banks safer by forcing them to hold more capital against their riskiest loans. Translation: banks had to stop doing a lot of the interesting, profitable, mid-market lending they used to do. Loans to mid-sized companies, leveraged buyout financing, risky but lucrative stuff. Banks were essentially told to grow up, be boring, and stop making the kind of loans that made them a lot of money, but also almost blew up the global economy, and that created a void. Into that void walked the private credit industry, and the pitch was simple, elegant, and genuinely useful. We will do the lending the banks no longer want to do. We will loan money to mid-sized companies. We will charge higher interest rates because these are riskier loans. And we will deliver consistent, attractive returns to investors who want income without the volatility of the stock market. For a while, it worked beautifully. The 5 largest players in this space, Apollo, Ares, Blackstone, Carlyle, and KKR, grew the asset class at 14% annually, compounded for an entire decade. A decade. Every year, 14% more money flooding in. And now they collectively control around $1.5 trillion in what's called perpetual capital. Capital that doesn't come back. Capital that just stays. By the early 2020s, private credit had become Wall Street's favorite product to sell. And here's the thing about Wall Street. When something works for institutions, they inevitably figure out how to sell it to you. Meet Sarah. Sarah is 54. Has been diligently maxing out her 401k for 30 years, and her financial advisor recently told her about something called a business development company, a BDC. It's essentially a fund that lends money to mid-sized companies that banks won't touch. It promises returns in the 8 to 10% range. No stock market volatility. Steady income. Perfect for someone approaching retirement. Sarah puts in $200,000. What Sarah was not told, and what the glossy brochure conveniently left out, is that this is not like a savings account. It is not like a stock she can sell on a Tuesday. It is a pool of loans to companies you have never heard of, priced by the fund itself with no external market to verify those prices, sitting in what the industry cheerfully calls a semi-liquid structure. Semi-liquid is Wall Street for you can get your money back, sometimes, in good conditions, within certain limits, if we feel like it. And this week, Sarah found out exactly what semi-liquid means in practice. Because on March 23rd of 2026, Apollo Global Management, the same Apollo that manages $25 billion in one of the largest retail-facing private credit funds on the planet, told investors who wanted to withdraw their money that they could only receive 45 cents on the dollar. The fund had received withdrawal requests equal to 11.2% of all shares outstanding. The quarterly withdrawal limit is 5%. The math did not work. The gate came down. And Apollo was not alone. Within 24 hours, Ares, another one of the giants, confirmed it was also capping withdrawals at its own funds. Blackstone's private credit vehicle reported that first-quarter redemption requests hit 7.9% of shares. Blackstone injected $400 million of its own balance sheet capital just to avoid looking like a fire sale. Blue Owl, another major player, has watched its stock fall over 38% in 2026 alone. And then, on Monday, Moody's delivered the finishing touch. They downgraded FSKKR Capital Corp., a $14 billion private credit fund run by KKR, all the way from investment grade down to junk, BA1, junk. The fund's non-accrual rate, meaning loans where borrowers have simply stopped making payments, climbed to 5.5% of total investments, one of the highest rates among comparable funds in the entire industry. The fund lost $114 million in a single quarter and earned just $11 million in net income for the entire year of 2025. That is not a typo. $11 million in net income for a $14 billion fund. That's a return that would embarrass a savings account. And now the uncomfortable question becomes obvious. If the returns aren't there, if borrowers aren't paying, and if the gates are coming down, what is actually going on inside these funds? Or here's the mechanism. And this is the part that should genuinely concern you. Private credit funds don't trade on an exchange. Unlike a stock or a bond that has a market price updated every second, private credit loans are valued by the funds themselves. The fund decides what its loan portfolio is worth. There is no external market screaming at them to mark things down. No Bloomberg terminal flashing red. Just a spreadsheet and an optimistic assumptions model. This creates what analysts are now calling the zombie loan problem. When a company that borrowed from a private credit fund can't afford to pay the interest on its loan in cash, the fund has two options. Call the loan, take the loss, and book the write-down. Or use something called a PIK loan, payment in kind, where instead of receiving cash interest, the fund just adds the unpaid interest on top of the outstanding principal. The company owes more. The fund records income it didn't actually receive, and the loan stays on the books looking healthy. The financial equivalent of the "I'll pay you back next week" that you both know is never coming. And 90% of private credit managers now expect to see more PIK loans in 2026. Not fewer, more. But here's where it gets genuinely systemic. Because private credit doesn't exist in a vacuum. Banks, the same banks that were supposedly pushed out of risky lending by Basel III, have quietly lent nearly $2 trillion in loans directly to these non-bank private credit firms. That number was $1.5 trillion just a year ago. So the banks didn't leave the game. They just moved one step back and became the wholesale lenders to the wholesale lenders. And about a quarter of that $2 trillion is flowing into private credit funds. Goldman Sachs analysts have estimated that, in a worst-case scenario, losses from private credit defaults could hit $105 billion. That sounds manageable until you realize those losses don't stay contained inside the private credit funds. They ripple back into the banks that lent to them, and then into the insurance companies and pension funds that hold stakes in those funds, and then into the bond markets those institutions participate in. One expert put it simply, it's so interconnected with the economics of everything. This, by the way, rhymes very loudly with something that happened before. In 2006 and 2007, the mortgage-backed securities market was doing something structurally identical. Loans packaged up, sold to investors who were told they were safe, all priced by the institutions holding them, rather than by any open market, and sitting inside semi-liquid structures that the average investor did not fully understand. The only difference this time is the collateral. Back then, it was houses. This time, it's mid-sized companies and software subscriptions. And speaking of software, here's the twist that nobody saw coming. Roughly 20 to 30% of many private credit fund portfolios are loans to software as a service companies, SaaS businesses. The companies that sell the subscriptions and monthly recurring revenue models that private equity loved buying and private credit loved financing throughout the zero interest rate era. And now, AI is threatening to gut the entire SaaS business model. If an AI tool can do in minutes what a SaaS platform charges $500 a month for, the revenue model collapses. The companies stop growing, the loans go bad, the funds mark them down, and the $2 trillion in bank exposure to these funds suddenly becomes a very uncomfortable conversation for a lot of people in very expensive suits. This is what Fitch is already tracking. The U.S. private credit default rate has climbed to 5.8%. the highest level in years. Now, to be fair, private credit funds are not going to zero. The structure itself provides some protection. Unlike a bank run where depositors can pull everything overnight, private credit gates mean the unwind is slow, measured, potentially grinding. Goldman's worst case of $105 billion in losses, while painful, is not a 2008 level event by itself. But here's what makes this genuinely dangerous. It's not the first loss, it's the feedback loop. When gates come down and investors can't access their money, trust in the asset class collapses. New capital stops flowing in. Existing managers have to sell assets to meet redemptions. Selling illiquid loans in a distressed market means selling them at a discount. That discount forces other managers to mark their own identical loans down. More investors panic, more redemptions, more gates, more selling. And by the time the cycle completes its first rotation, the thing that was supposed to be the safe, boring alternative to the stock market has become the most dangerous slow-moving fire in the entire financial system. So, where does that leave you? Here is the uncomfortable truth that Wall Street does not want to say out loud. The private credit boom of the last decade was built on three assumptions that are all cracking at the same time. First, that interest rates would stay low enough for mid-market companies to service their debt. They didn't. The Fed raised rates at the fastest pace in 40 years, and a lot of these borrowers are now struggling. Second, that the AI and software companies borrowing from these funds would grow into their valuations. They're not, because AI is eating their business models. Third, that the semi-liquid structure would hold under pressure. The gates at Apollo and Ares this week just proved that it doesn't. And the part that nobody wants to say is this: the retail investors sitting in BDCs and interval funds, your pension fund, your financial advisor's favorite income-generating alternative, Sarah's $200,000, were the last ones in. They always are. The institutions came first, made their money, and then the product got sold downstream to the people who could least afford to find out the hard way what semi-liquid actually means. Because when a fund gates, it doesn't gate for the institutions who got in early and have already earned years of distributions. It gates for the people still waiting to get out. So, here we are, $3 trillion in private credit, $2 trillion in bank exposure to that market, a 5.8% default rate and climbing. Gates shutting at Apollo, Ares, and Blackstone simultaneously. Moody's downgrading KKR to junk. Blue Owl down 38% on the year, and 20 to 30% of the underlying loan portfolios pointed directly at the companies most threatened by the AI revolution. If all of this sounds like the beginning of something, it might be. And if it sounds like we've seen this movie before, it's because we have. Like, the names are different. The collateral is different. But the structure, the opacity, the optimistic marks, the retail distribution, the illiquidity dressed up as stability, is exactly the same. The question now is whether this is a contained stress event that the market absorbs and moves on from, or whether it's the first domino in something much uglier. I want to know where you land. Do you think, A, this is a manageable correction and private credit survives mostly intact? B, this is the beginning of a slow-motion unwind that bleeds into broader markets over the next 12 to 24 months? Or C, this is the 2008 moment nobody saw coming and the dominoes are already falling? Drop your answer in the comments, because this is one of those moments where the consensus view is almost certainly wrong and the right answer is hiding somewhere in the comment section.